Stocks have outperformed bonds 2 years in a row. Wall Street expects the streak to continue in 2025, but this will depend on a rebalancing of growth from the US, China, and India to Europe, Japan, and Canada. Is this realistic? What does policy uncertainty have to do with it? What should you do with your money now? Ray Dalio made his name and fortune selling a regime-agnostic approach to investing. He named the flagship fund of Bridgewater the All-Weather Fund, promising that it would ride out different macroeconomic trajectories. Following an incredible run that lasted more than 2 decades, risk parity crashed in 2022. For the first time since the Lehman collapse in 2008, risk parity produced practically no returns over a 3-year period. As asset allocators wake up to the realization that risk parity owed much of its previous success to global disinflationary forces that are probably not coming back, regime-based approach to investing has witnessed a revival of sorts. Conceptually, regime-based investing is fairly straightforward. The market cares about inflation and growth. And at any given point in time, inflation and growth are either going up or going down. This means there are only 4 combinations of possible outcomes. Regime-based investing is based on the observation that relative performance of assets can differ widely in these outcomes. For example, when inflation goes up more than expected and growth goes down more than expected, gold tends to do well. Or when growth and inflation both go up more than expected, commodities tend to outperform. In the world of regime investing, making money only requires picking the right regime, or at least assigning the highest probability to the right regime. But this is, of course, easier said than done. So which regime will prevail in 2025? Business cycle theory says that regimes are not random, in that they follow a certain order. This means which of our 4 regimes will prevail in 2025 depends on what happened in 2024. Among major asset classes, stocks were the best performer in 2024. MSCI World was up 20% on the year, compared to a 9% return of S&P GSCI Commodity Index and a 3% decline of the Bloomberg Global Aggregate, a global investment-grade bond index. The fact that stocks outperformed both commodities and bonds in 2024 implies that growth was stronger than expected and inflation lower than expected. But was this true? Without a doubt. A year ago, the Wall Street consensus was that there was a 65% chance that the US economy could fall into a recession in 2024, and that inflation will remain sticky. The global decline in inflation was generally faster than expected. What are the chances that this benign state of affairs is set to continue in 2025? The consensus is that global growth will remain strong in 2025. The IMF is forecasting that we will see another 3.2% growth. This forecast is not without logic, but in my view, the risk is to the downside. There was a lot of excitement last month about the big uptick in ISM manufacturing, seen as a good leading indicator for the US and the global economy. However, this appears to be in part driven by inventory building ahead of a potential tariff war after Trump takes office. Whether this continues in December or not, this would have been at the expense of economic growth in 2025. US inventory restocking should have benefited Chinese manufacturers. The fact that both of China's manufacturing PMIs still declined in December says a lot about just how weak Chinese manufacturing is right now. And it's not only Chinese manufacturing that is struggling. South Korean exports, a leading indicator for global manufacturing activities, are barely growing. South Korean manufacturing PMI slipped into contractionary territory in December, for the first time since July 2020. The picture does not look too different for Taiwan, despite the massive boost to TSMC from the surge in AI-related chip orders, and with global semiconductor sales growing at 20%. Both Gartner and IDC are forecasting a slowdown in global semiconductor sales in 2025. This in part reflects the fact that the iPhone 16 launch, the first AI phone by Apple, has been less successful than expected. You can judge for yourself whether it is a flop, but the fact is that Amazon is offering a rare discount on the iPhone 16 right now. If iPhones are not selling, it could be because people are buying cars instead. In November, 16.5 million cars were sold in the US on an annualized basis, a big jump from the previous months. But this had more to do with heavy discounting by dealers, who have seen their inventory rising to pre-pandemic levels. Chinese passenger car sales also accelerated in the past 3 months as the result of the doubling of subsidies on EVs by the Chinese government. Whether it is subsidies in China or discounts in the US, all they are doing is bringing forward future demand. This does not bode well for 2025. What about Europe? Auto sales are depressed, stuck near the low of the past 3 years. Stellantis, the maker of Fiat and Peugeot, saw its revenue slump by nearly 30% in Q3. If there's any light at the end of the tunnel for global manufacturing, I'm having difficulty seeing it. What about the service sector that has been pulling the global economy along in the past 2 years? If we were to judge based on how often people are dining out, the picture looks good. According to data from OpenTable, there was a 15% increase in the number of global diners seated over the past month compared to the same time last year. And this recovery seemed pretty broad-based, at least among the English-speaking countries. And surveys by OpenTable suggest that the trend is set to continue in 2025. 54% of their respondents said that they plan to eat out more often in 2025. What is interesting about this finding is that young people, 71% of Gen Z and 68% of millennials, said that they plan to dine out more often in 2025. I guess we now know why iPhone 16 is not selling. The inevitable conclusion is that the post-pandemic change in spending patterns may be more permanent than we thought. But can eating out and taking cruises drive the global economy in 2025? Spending on eating out and vacation are famously susceptible to the vagary of the stock market. I wouldn't bet my house on it. As I said, I think the risk to the consensus forecast for global growth this year is to the downside. And this is why. If we look at the breakdown of the consensus global growth forecast, what really stands out is the fact that all the high-growth countries in 2024 are expected to slow in 2025. These include India, China, Russia, Brazil, and the United States. The countries that are expected to grow faster and offset the slowdown of the high flyers include Japan, the Eurozone, Canada, and Australia. So Europe, Japan, and Canada are going to save the world economy in 2025? Is this Wall Street's sad joke? The reason why the expected rebound in these economies is so unconvincing is that Germany, France, and Canada are ranked among the major economies with the highest level of policy uncertainty. If I know anything at all, policy uncertainty tends to depress economic growth by delaying investments in consumption. Wall Street economists think that interest rate cuts by the ECB will help shake the Eurozone out of its doldrums. In my view, policy uncertainty will go a long way to offset any positive impact from monetary stimulus. As I discussed last week, a German recovery requires a major change in policies that would necessitate unshackling the country from the tyranny of the Green Party in next month's federal elections. At this point, it is far from certain that the Christian Democrats and the Social Democrats can form a government without the Greens. And if these parties do not end up with 50% of the seats in the Bundestag, negotiations to form a grand coalition might take months. In other words, there's a good chance that the elections will not resolve the current uncertainty. I have a lot of respect for Elon Musk, but his declaration of support for the AfD makes it more likely that the Greens and not the AfD will be in the next German government. This is because no mainstream party will go into a coalition government with the AfD, and the more votes it gets, the less likely the CDU and the SPD will be able to cross the 50% threshold. It is simple math. Meanwhile, German manufacturing is going from a recession into a depression. One can recover from a recession, but not from a depression. With many German companies relocating to other countries, Germany is rapidly approaching the point of no return. What about France? France is even further down the path of no return. It got a new prime minister last week. He's been no more successful in bridging the gap between the populist right and the populist left than his predecessor. With the Socialist Party scorning his offer to join the government, François Bayrou will have to make do with a minority government like the outgoing Barnier. I would not rule out that sometime before the spring, French bonds will decisively trade through Greek bonds. As Voltaire wrote in Candide, optimism is the obstinacy of maintaining that everything is best when it is worse. As I said a few months ago, France needs an economic crisis to come to its senses. For the sake of France, I hope 2025 will bring on this moment of reckoning. What about Japan? There's a lot about Japan to like, but its debt problem is catching up with it rapidly. The Japanese yen is at its weakest level in 40 years against the US dollar. But this has had zero positive impact on Japanese export volume. Meanwhile, the Japanese are paying more for everything they import. With inflation rising, the Bank of Japan is the only major central bank, other than the Brazilian and the Russian central banks, expected to raise interest rates in 2025. But the Bank of Japan is wary of hiking rates too quickly, lest it should increase the fiscal burden of the most indebted government in the world. Japan is in a new vicious circle from which there is no obvious escape. What about Canada? The expectation of a growth rebound of the Canadian economy in 2025 is predicated on the assumption that the aggressive interest rate cuts by the Bank of Canada over the past few months will help boost spending. No doubt lower interest rates will help stabilize the depressed housing market. Policies under Justin Trudeau have been one unmitigated disaster after another. However, with Trudeau determined to run again in the next general election, in his approval rating at just 26%, he has no incentive to call the general election before the absolute deadline of October 20, 2025. Which means policy uncertainty will hang over Canada until then. Even though the Conservatives are very likely to win an outright majority, the Canadians will have to wait another year before any serious attempt addressing the snowballing problems on multiple fronts. The bottom line, I struggle to see how Germany, France, Japan, and Canada will help offset the coming slowdown of India, China, Brazil, and the US in 2025. Let me emphasize again, the risk to global growth in 2025 is to the downside. As much as I see Trump 2.0 as bullish for US growth over the medium term, I'm less sure about the short term. Even though I am more optimistic than the consensus about the scope for a deal between the US and China, there is no denying that policy uncertainty with respect to trade has gone up. But it is not just trade. I don't doubt that Trump will move quickly to avoid a protracted period of uncertainty. But the fact that the next Speaker of the House will face the narrowest Republican majority in 100 years will slow him down. I will talk more about this problem next week, but it suffices to say that I am concerned about what Trump will be able to achieve using executive actions alone, at least in the first 100 days of his presidency. This brings me back to our 4 macro regimes. My bet is that both growth and inflation will be weaker relative to expectations in 2025. For that reason, I like owning US government bonds up to the 5-year maturity point. Given the uncertainty with respect to Trump's tariff threat, it is a position I would ease into. Thank you for listening.